Hello and welcome to the Stansberry Investor Hour. I'm your host, Dan Ferris. I'm also the editor of Extreme Value and the Ferris Report, both published by Stansberry Research.
And I'm Corey McLaughlin, editor of the Stansberry Daily Digest. Today, Dan interviews Michael Harris, author and former hedge fund trader.
And in our rant today, we'll talk about PCE inflation, the Fed, of course, and meme stocks and whatever else is on our minds.
And remember, if you want to tell us what's on your mind, email us at feedback@investorhour.com and let us know.
That and more right now on the Stansberry Investor Hour. Well, we can't not talk about personal consumption expenditures numbers that just came in, so we may as well do that first.
All right. What are they?
Yeah. All right. The PCE index, of course, is personal consumption expenditures. It's just a way to gauge inflation. It's the Fed's favorite way, or one of their favorite ways to think about inflation. And it's done monthly, just like the CPI. And it just came out, and the yearly increase in prices declined from 5.3% in the prior month, year over year, right? Annualized to 5%. So, lowest level in like a year and a half or so. And, the narrative is the same, right? Inflation is peaking. Inflation has peaked. I'm not sure if I'm comfortable saying that, but yes, the rate of year over year changes in CPI and PCE has been falling. And so you can't ignore that. I don't think we're headed back to 2% anytime soon, but sure, it's not 9 anymore. It's not 6, 7, 8, 9 anymore, right?
Right. I mean, it's still really high, though. I mean, compared, it's more than double what their goal is, the Fed's goal of the 2% goal. So you would think some of the I think what they're banking on is the kind of real estate associated costs and rents and that sort of thing that come down the second half of the year, which they might. I've never thought inflation was going back down to 2%, and I just didn't see how it could happen because I never thought the Fed would be able to hike rates as high as they would have to before things started falling apart. And I think that's at the point we're at right now. So, yeah, I mean, again, the pace of inflation may have peaked, but inflation is still here and it's very high. I think I go to sleep at night sometimes saying that to myself, right? No, no, I'm just kidding.
I know. Yeah, no, I sort of do too. And an important point here, though, is, of course, the Fed funds target right now, the target range is 4.75 to 5. Upper limit is 5. So now PCE, which the Fed likes to look at, is 5 and, maybe coming down, right? It was above 5, now it's 5. So do we, they still hiked last time. And, if you look at something like these sort of market-based things, the CME has a Fed Watch tool, and it's saying, that it basically says the probability of a target range for the next meeting. So the probability of the target range staying at 4.75 to 5 is 50.5%, they say. And the probability of the target range being 5 to 5.25 is 49.5%, they say.
Right. So 50-50
So,
shot.
yeah.
And
that,
yeah, and these are the bond traders that trade Fed futures. That's what those probabilities are based on. And these, so they don't know. I mean, they're hedging basically on either one way or another. So it's either a yes, they hike 25 or nothing at this point is kind of the market expectation. These expectations, though, change wildly with like every piece of Fed related or inflation related data that comes out. And so we'll have more jobs numbers and the next CPI and all kinds of things between now and the next Fed meeting in May. And we don't know what else is going to happen between now and then as far as the banking system or anything else. The war in Eastern Europe, which is still going on, and all kinds of other stuff that we have happening. So yeah, that could change. I mean, a couple of months ago, these same group of people were banking on a 6% uh, terminal rate this summer, and that came down after all the run on Silicon Valley Bank and all the fears that came after that. So um, yeah, it's this weird kind of this is the again the trouble with trying to manipulate all this stuff from a high level with the Fed and with what they have to work with is interest rates and their balance sheet. And it's just this doesn't Joe and Mary on the street don't aren't making everyday decisions with the Fed in mind. And so there's a huge disconnect on like the real economy versus the banking slash financial economy, whatever you want to call it. So it's
No, it's right, yeah. They're not sitting here looking at, 4th quarter GDP 2.6% and thinking, "God, what if that comes in any higher? What if there's growth that no one is thinking about? What does that do to the yield curve?" I think it reprices it. I've seen a really good thread with our podcast guest, David Cervantes, who was on the show a while back, and another guy, Bridgewater guy named Bob Elliott. And I mean, David has me wondering about this. Like, you know, if I saw a headline recently about multi-week or something low mortgage rates. Mortgage rates have been falling recently because the bond yields have been falling a little bit. And I think, wow, this stuff makes it right into the headlines and it becomes the narrative. What's going to happen if we get GDP of like 3 or, even 2.8, 2.9, anything higher than the fourth quarter of 2022?
what do you think?
Mm, I don't, I think that we get higher bond yields and I think that we get, you know, that's lower bond prices, higher bond yields. The stock market won't like it because as soon as we see higher growth, oh boy, the Fed's not done, you know? Those are the assumptions are like the Fed's going to break things and slow everything down. But what if it's
Right.
not? And you and I keep coming back to this point about inflation being sticky, which a lot of folks will say, well, all the effects are lagging, and I get that, but I'm going to stay with sticky because, well, you put that money in the system and you don't get rid of it, right?
Yeah, I mean, what if we had the last 80 years or what, however, have have prices on anything gone down significantly except for, like the technology that gets like cheaper to make and that sort of thing.
Did you see the blog post by Mark Andreessen about that very
I did
topic?
not.
He did this blog post recently where he says, Mark Andreessen, the big Silicon Valley venture guy, the guy who what did he do? He invented browsers, or he put out the first browser that was widely used.
He said
Anyway,
he wrote a famous
he
kind of piece, I don't know how many years ago, "Software is eating the world."
was
Yeah.
eating the
Yeah.
right, that guy. So Andreessen comes out with this blog post. He says, we're going towards a world where a college education costs $1 million and a giant big screen TV costs $100. And his point was in things like education and healthcare, it just keeps getting more expensive. And he says the government's heavily involved and it's heavily regulated. And these other things, big screen TVs aren't heavily regulated. It's pure technology driven.
Right.
And I keep saying this, especially about healthcare. It's so technology driven. Why isn't the cost coming down and down and down? And, I think it's because of the way things are, partially because the government's heavily involved and because everything is covered by insurance, which strikes me as a layer of administration that should not exist. And mm, I don't know. I think he has a really fair point, and it certainly speaks to my own personal sensibilities about these things. But that's a weird world, you have to admit. It's a weird world where we would get, dirt cheap giant screen TVs and super expensive things like education and healthcare. They're kind of important, aren't they?
Yes, they are, and I that's one of my least favorite charts of the last, 5 years or whatever I've seen is exactly what you and he are talking about is the inflation rate of things that are kind of tied up in government regulation or just like giant kind of battleship sort of industries, like college, which is an industry. It probably shouldn't be, but college and healthcare, health insurance versus exactly what you're talking about, like just products that the government doesn't necessarily care about because they're not political, and those prices are just kind of they're still inflating, but they're not at nowhere near the same rate as like college education, which I think is the category that's probably inflated the most in the chart I'm thinking about. I can't remember exactly when it started, but it's at least a couple decades ago. And so, yeah, I mean, what this is just like stuff that has been going on for years, and it's things that it just keeps dragging on and on and on and on, and there's never a solution to it. And is the Fed raking hike?
Right, a lot of
Yeah, is the
political
Fed
momentum.
hiking rates going to solve this problem? I don't think so.
No.
It'll solve the whatever CPI and PCE numbers on a piece of paper. Um, but will it solve all
Mhm.
the different tentacles of the economy that are the levers that are driving prices up and higher and higher? No. So I don't know.
No, and changing elected officials won't solve it either. I promised people in our opening that we would talk about meme stocks, so I hate to pivot awkwardly, but attention, awkward pivot
Meme stock
ahead.
alert.
Yeah, I wanted to get to this because it's still a thing. I mean, these companies still exist. GameStop and AMC and Bed Bath and Beyond was the most recent one. The stock price has been mostly below a dollar lately. And, it's down whatever, 99% from its all-time high. It's ridiculous. And, Matt Levine in Bloomberg, I thought, had a great point. And he noticed that if this stuff had never become meme stocks, they wouldn't have been able to raise all this capital at much, much, much higher prices and basically incinerate all that money. And then he referred to the Hudson Bay deal with Bed Bath and Beyond, which was basically like Bed Bath and Beyond is so screwed they finally can't sell any more equity. So they sell these, convertible preferreds to Hudson Bay, and then Hudson Bay converts and dribbles it out into the market, which they're probably doing it every day. They actually can't do it anymore finally, but they were probably doing it every day, right? So the point stands that Matt Levine was making, which is that had the stuff never become meme stocks, they never would have been able to raise all this extra capital, which of course they then incinerated. All of these stocks are way, way, way below their meme stock highs, and they're not worth the businesses aren't
The
worth
meme stock
anything.
highs just makes me chuckle.
So, right, I keep getting lost in, let's see, what, the implications of higher interest rates, but I keep winding up going back to, well, wait a minute. This is an outcome of zero of ZERP, zero interest rate policy for the better part of the last 12 years. So, everybody talks about, and Kathy Wood's another one, talks about how the Fed destroyed everything. But she wasn't say the Fed made all her garbagey businesses that she buys possible. Like when interest rates were zero, nobody was like blaming the Fed, but the truth is it's like Warren Buffett says, you don't know who's swimming naked till the tide goes out. They were swimming naked the whole time. Like the whole time when everybody was having fun, when those stocks were soaring and peaking in 2020 and 2021. And yet only now people are saying, oh, the Fed's breaking everything with higher interest rates. They're like almost up to normal interest rates. Historically speaking, they're just kind of normal.
Yeah, I mean, rate
It was the low
right,
ones that
exactly.
broke
Rates weren't
everything.
at 5% all that long ago. I mean, it's the yeah, totally. It's the 0% world that a large chunk of people have just come to expect and thought is never going to change, and so it's it's changing, and so I yeah, you're right. I mean, me and you, we've been talking about this how these kind of big trends have been changing for whatever 6 months, a year or more. I forget that there's a lot of people that don't think that way and and think that rates are going back to zero. I mean, or they should go back to zero. I'm like, what are we? talking about here? Do we have no sense of how we got here? I get most people don't. So it's or a lot of, I think, the Kathy Woods of the world, either they don't or they're just being totally disingenuous and want to create headlines and do their marketing and whatever and get people into their funds, and um, that all happens too. So I'm not naive to that, but it's um, yeah, I do think though more it's a chunk of people that have been conditioned a certain way to go about business life, and that's what we saw with
Yeah,
the Silicon Valley
it's
Bank. Yeah,
normal.
this whole story I think has been the tech. I mean, tech has kind of led this bubble on it from a headline basis, like all the way up, and now it's leading it on the way down. Like you've said before, like of course the crap's going to break first with you know like a Silicon Valley Bank that was just making all kinds of bad decisions, and with a client base that is like fuck, like jittery and like on their computers and just like, oh my god, what's going to happen here, and uh you know pulls out what is it, 40 billion in a day. So I mean,
142 billion in 2
142 in
days.
2 days. And I did, like, Jerome Powell said that, like, actually during his press conference, and I was like agreeing with him that we just haven't like seen that before. And we woke up the next morning like, how did this happen? Like, well, okay, you guys are in charge of all of the banks, but don't worry about it. Anyway, I don't know where I was going there, but yes, your point about the meme stock people complaining now. I mean, that's just like when a bubble bursts. Yeah, that's what that's the breaks.
The whole thing is Yep, the whole thing is so perverse because, the meme stock phenomenon was about people, buying stocks that were heavily shorted. It started out buying stocks that were heavily shorted to these powerful, short covering rallies. That's what those rallies were, and yet, like, it was a very stick it to the man kind of thing, and Melvin Capital, actually, they went out of business because they were short, I think, GameStop and AMC, but I know GameStop was one of their shorts, and also, um, Citadel, the big, Ken Griffin's hedge fund, like, they were short some of this stuff too, and there was, like, rallying cries on social media about sticking it to the man and all this stuff, but in the end, you know, um, the trading was fantastic for Ken Griffin's securities business, so all the options trading that those people do, and, Melvin Capital went out of business, so they got them, I guess, but in the end, it was the man stuck it to them. I mean, Hudson Bay Capital made a ton of money, you know? They bought a bunch of cheap stock, they converted it, and they just sold it and sold it and sold it, and now Bed Bath& and Beyond is, like, below a dollar, and if these things had never become meme stocks, like, GameStop would probably still be 2 or $3 or something, because they wouldn't have been able to raise all this capital. It's perverse. Like, low interest rates, people think, "Well, you know, this is good because 'cause it'll pump my stocks back up or whatever." No, it hurt you worst of all. It hurt the little guy worst of all. You couldn't save money. You couldn't make anything in a bank account. You couldn't put your money in a bank account and make 5 or 6% anymore. You still can't. Deposit rates are slow. They lag, uh, you know, Fed funds and all these other rates.
And now, I mean, and now you can make
And
more. You can make more
ugh,
in a like T-bills and stuff, but you're still inflation is still so
yeah,
high that you're still
money
getting screwed.
markets,
So
yeah, and
yeah,
that's
you're
the
like
other
just
thing.
trying to keep up, and feel like that's what we're doing as a society or a world, is just trying to keep up with all these issues that are out there, which is not the way to
Right.
grow and be a productive place or business or anything. So
Right, so now they're rushing into money market funds because they
yeah,
pay more. And of course, everybody says, "Oh, money market funds, Lehman Brothers, blah, blah, blah." The money market funds broke in September 2008 when Lehman Brothers went under because the money markets were holding Lehman commercial paper. The primary reserve fund, the big one, broke. So, but now I looked at a bunch of them, and it's mostly government securities now, and I'm like, okay, well, that's probably safe. Oh, wait a minute, they're the ones that lost 20 or 30% last year, right? So I mean, I hope it turns out okay, but it's like zero interest rates for 12 years is the most distorting. It's the most pervasive sort of blanket social distortion that I've ever witnessed, and I didn't realize it, and I'm only now starting to realize, that it's not just interest rates. It's freaking interest rates. It's the price. It's the most important price in the world, the price of money, you know, and it distorted everything, and you can't escape it. Nobody could escape it. And on
Yeah,
that
well, you
sunny
can't escape
note,
it even if you don't know it. It's there's most
yeah,
I hate talking about the Fed, but they are this is what they're a big player in our world, and keep no matter what they do, keep driving this gap, like the wealth gap between the really really rich and average poor, whatever you want to say, and everybody else. And it's like it's inflation also is a killer. It's just a killer. This high inflation. I mean, I was talking
hmm
to a friend of mine who runs kind of manages engineering projects, right? And so he has a lot of people working for him on different projects. And he's just like, nobody wants to like take any quality in their work anymore. And this guy's like younger, and he's like sounds like
hmm
old and jaded and like a 40-year veteran of just like crap going on, and he's not. And so it's and my point is that stems from all of the pandemic stimulus, I think, and which resulted from this 15 years of low rates and on, just the snowball of everything and where we are at this point. So, yes, on that sunny note, I guess we can move on to better thoughts, maybe from our guest. So,
yes, yes, let's do that. I follow Michael Harris on Twitter. That's why I wanted to have him on the show. That's how I know him, from Twitter, and he's a very smart guy. And he's sort of he's a like almost like a very sort of polite collegial kind of version of Nassim Taleb, which doesn't do Mike justice. He's more than that, of course, but his statistical knowledge is in that level. And yet, unlike Taleb, he's a really sort of polite, nice guy who's taught me a thing or two over the past few years on Twitter and in his YouTube videos and things. I read his book, one of his books, the book about technical analysis. I didn't understand a lot of it, but the parts I understood were fantastic. So, really brilliant guy. Can't wait for our listeners to get a load of him. So let's do that. Let's talk with Mike Harris. Let's do it right now. It's official. Mark Chaikin just went live with the biggest prediction of his career. A new wave of volatility is coming for the stock market, and investors need to act immediately. Mark's prediction is based on an indicator that has only triggered a handful of times in the last 72 years, with a 100% success rate for predicting where stocks will go next. During Mark's 50-year career, he's worked alongside some of the biggest investors in history, including Paul Tudor Jones and Michael Steinhardt. In fact, Mark invented one of Wall Street's most popular indicators for picking stocks, still used today by hedge funds, banks, and brokerage sites, and also is found on every Bloomberg terminal on the planet. Now, Mark's inviting you to watch his brand new event as he explains exactly what the next wave of volatility will look like and where it will send stocks in the coming weeks. He's even sharing one of his favorite ideas for free for those who tune in. He says this idea could create bigger gains than anything he's used his power gauge system for until now by turning the coming market volatility to your advantage. But Mark says you must act today before more volatility hits the market. To watch his newest prediction in full, go to chaikinevent23.com. That's CHAIKIN event23.com. All right, it's time for our interview once again. Today's guest is Michael Harris. Michael, welcome to the show.
Thank you, Dan. Thank you for the invitation.
Yeah, I was really curious to have you on. I want our listeners to know I really enjoy following you on Twitter. there are a lot of people on Twitter who call themselves traders, but none of them tweet the kind of things you do. Almost none. Your Twitter feed is very, very different. Different in a good way. I want to make that clear. And I think it's because you tweet kind of sometimes it's like very serious quantitative stuff, which is your background as a quantitative trader. So that's why I wanted to have you on, because you touch on some topics that most of our listeners don't know anything about. And you're a practitioner, you've had a career doing this. So I thought, this guy is perfect. I've had the thought when I've listened to a lot of people who are trading technicals, those that seem to survive, they don't survive by trading their signals. They survive by exiting their losses faster than other people. It seems like that's much more important than, I feel as though they're throwing darts for the signals. They're taking any, the signals seem random, as you say, and yet people seem to survive, and some of them seem to make money. And then when I talk to them, I feel like, what you're doing is taking very, very good care and not allowing losses to get past a certain point. And if you do that, if you survive, you will be around for that time, when the signals go your way. So it's sort of like, it was like when I was a kid, and I remember a friend's mother would say, if you kids stand next to that creek, you keep playing around that creek, you're going to fall in one day. and the folks who seem to, fall in and make money once in a while are the ones this is purely anecdotal from my perspective, having interviewed dozens and dozens of people. It seems like they're just have an iron discipline about cutting their losses and trading small position sizes and so forth and so forth.
Yeah, you know how difficult that is. It's totally inhuman. It's against what you have learned in school to be successful. But there are examples of some fund managers and CPAs who have done this for 30 years. And they have made, like 9-10% annualized return. Of course, the drawdowns are large, 30%, some of them 50%. That's another parameter. But yes, cut your losses short, let the profits run. It's a nice narrative, but it's extremely difficult. And that's the basis for trend following and CTAs and managed futures. That's where they are concentrating. And also by adding many markets, they try to catch those trades that will produce profits. Although the whole concept breaks down if you look at it from, if you scrutinize it, it's a nice narrative, but if you scrutinize it quantitatively, you can separate marketing from reality. Because as you increase the number of markets, you get some claim they trade 200, 300 markets, 400. If you trade so many markets to size your positions and maintain a smaller risk, at some point you get to 1/n. Position is 1/n. N is the number of markets.
So 1/400. I mean, yeah.
Yeah. That's where your position gets. You get, because your positions, your risk is very small, you get many losses. You can get maybe 40, 50 consecutive losses. And I have gone through all this. I'm not a managed futures insider marketing person, but I have gone with skin in the game through all this. Those who remain in the market, as far as I'm concerned, are survivors, random survivors. Maybe they had, it's like 60-40, 60 skill and 40 luck. Many were ruined. Many didn't make it. Many try because there is no barrier to entry. Like, for instance, trend following, managed futures. The signals are trivial. Breakouts, moving averages. Anyone can do it. Any one of your listeners can do it right now. The problem is risk management And those consecutive losers, you can lose your discipline and say, let's keep the trade a little bit longer, maybe recovers, and then you get a 50% loss. And you are out. The margin clerk calls and says, you need to put more money or close the account. So it's not an easy game.
Right, and yet it's such a good story, going all the way back to like the Market Wizards books and the Turtle Traders. You mentioned Dennis. It's such a great story, and everyone says, "Well, I can do that. I can do that." But
Sure.
I feel like the point they never make is the point that you made that I sort of chimed in, is that it's inhuman. It's not anything, like you said, it's nothing that life has prepared you for. It is completely different than the way 99.99999% of everybody operates and thinks. And it's not anything that being a human prepares you for.
And why doing it after all? I have an article on my site, February 28. Trend CTAs have failed to outperform the simplest momentum strategy. Nowadays, every investor has the ability to track the 12-month moving average, get out when it drops below from SPY, because that's what most people follow. That's the large cap market, and then get in when it when it courses again. And this simple system has outperformed the CTAs and the managed futures, and no one speaks about this. And they also refrain from commenting in my Twitter threads
Yes.
when I mention this, because there are two things that need clarification. How much systematic are all those managers who claim to be systematic? As far as I can understand, and through statistical analysis, they are discretionary, and they have had great luck. I took the two indexes, systematic. They are compiled. Systematic, those who claim to be systematic, and the discretionary. Some people say I'm discretionary. It's not bad. As far as I'm concerned, it's a good thing to be discretionary. And I run statistical analysis, and all the statistical tests say that their performance is statistically indistinguishable. So what's happening here? It's simple. The market doesn't care. When you enter a trade, the market, no one calls you and say, "Hey, hi, are you systematic or discretionary?" I mean, there is so much, I do not intend to make fun, but there is so much marketing and hype that doesn't meet reality. It's all how we're going to increase the AUM, charge that 1% management fee, and trade 1,000 markets. And from, maybe you saw my article, do you want to say? From 2009 to 2019, the top 10 CTAs on the average had zero return. Why? Because if you have like 1 billion AUM and you charge 2%, it's good money. Management fee, it's good money.
Yeah.
You have 2-3 people in the office. All the marketing is managed by, outside, and, there are bigger banks that handle the legal aspect and the mark to market and the statements. There are companies that do that. So you can take this money and trade 1,000 markets and basically become a capital preservation machine and charge a fee. And I have an article the other day, I call this banditry.
Banditry.
Yeah, banditry. Because that's from the book, The Laws of Human Stupidity. Because when they lose money, They charge the customer and they lose money. And in the book, it's called a bandit.
Right. Most active management is essentially banditry, right?
Exactly.
They're getting assets under management, charging fees.
I'm glad we agree.
Well, yeah, I mean, for most of my, well, certainly for the last couple of decades, and really the last 3 that I've been sort of an active investor and involved in the things I'm doing, I've heard this over and over again. And the thing that really astounds me is that the lack of ability for most active managers to beat the market. It doesn't seem like we can repeat it over and over again. We can write about it everywhere. We can tell the whole world, and yet it never seems to kind of penetrate. It never. It's an unpopular idea. People want to get their hands on their own account, and they want to manage it, and they want to trade, and they want excitement and adrenaline, dopamine.
There is no strategy known to human beings that will outperform the best trading system in the world, which is the S&P 500. It's the best trading strategy in the world. I have written an article about. There is no way the people that make this index, they are smarter than everyone else. I mean, well, maybe they are not smart. They select the best companies. It's simple. It's simple. So you are trying to beat this high capitalization, large cap index with risk-adjusted returns. It's impossible. You need leverage to beat it. So someone can argue, yes, I can put managed futures, and I have written an article about it in Seeking Alpha, DBMF and SPY, and I make 60 DBMF, 40% DBMF, 60 SPY. But to beat the market, you have to leverage. I give you some numbers from 2000, if you are interested, of course. From 2000, the S&P 500 total return is up 6.5%. SPY, 55.2% drawdown. The return is 325% total return. If you put like 60-40 if you put 90% stocks and 10% CTAs, DBMF, for instance, you will get 6.1% and 300% total return you would have generated. So you already lose 25%. But you have a better drawdown. Instead of 55, you have 49%. It's not much. Now, if you put 60% in SPY and 40% in the aggregate bond ETF, AGG, you get 5%, with 32.6% drawdown. So it's not that much of a difference to invest in these ETFs and add them to a portfolio. And what happens is you're going to lose total return. And at the end of the day, I made a video today. It's in my Twitter stream. Since 2000, let me see the exact numbers. Since 2000, S&P 500 total return is up to 90%. The trend CTAs are up 85%. The 64 is up 171%. Now, there are two types of investors. Those who can sleep with drawdowns and actually find them opportunity to add martingale, it's called in quant. You add down. The gamblers started that in casinos. And then, like in 2009, you say, if the market drops 40%, I will add to my positions. In 2020, they did that. They do that. They enjoy. I remember I had a classmate at Columbia. She was a very wealthy person. And one day someone came and said, the market dropped. she called the broker and said, buy some more. Because that's what the rich do. They add, because their premise, Dan, is the following. As long as the US dollar is reserve currency of the world, the US dominates in technology. I mean, the dominance is like 90%. All the tech comes from USA and is produced in China. The China are the maids. As long as the tech dominates the largest military complex in the world, the United States stock market will have a positive drift. It will have ups and downs, and these rich people, they see the downs as opportunities to add to their positions, because they know after 5 years, after 10 years, even if they die, their kids will benefit from their decisions.
Michael, you sound like Warren Buffett. Buy the USA whenever it's down.
There is no other game in town. Someone was talking about emerging markets today. I have written so many articles. Emerging markets, long positions in emerging markets. It's a short US dollar position with appropriate leverage. When you see the dollar going up, you got to be crazy to invest. The emerging markets suffer when the dollar goes up. Commodities fall and everything else, because they are priced in terms of US dollars. So you don't have to invest in as a US-based investors with a base currency, the US dollar. You should listen to these managers. They are just looking for high fees from emerging markets. If you want to invest in emerging markets, you just take a short US dollar position in a forex broker. I mean, it's that simple. It may not always work, but this is the pattern. And also Europe. It seems it works for Europe if you take the correlation. So
the two biggest currencies in the world.
Yeah, the euro and the euro is a servant. It's a master-slave relationship. After the US spent lots of money for the euro to be instituted, because the US multinationals wanted to deal only with one currency when selling to Europe. This was, don't listen to anything else. I suggest about what was the reason for the formation of the euro. It was because the bureaucracy and the paperwork for selling to Germany, to Italy, to all these countries, France, was terrible. For the US multinationals. So they said, let's unite these people and come up with a nice narrative that they are doing it to unite their peoples, because we're going to have only one currency in our books when we sell. This was the purpose of the euro. If Americans didn't want the euro, it wouldn't exist.
Yeah. Meanwhile, back in reality, to get those people in all those disparate countries in Europe to agree on the subject of money was probably not a great idea.
It created imbalances, and the South basically was a wealth transfer and everything. And there have been like 10, 15 more unions in the history of Europe in the past, other small, larger, few countries, many countries, and all collapsed. And also this one, due to the complexity, will collapse, because all complex systems that are centralized eventually collapse. If people visit my website, I gave a presentation in a M4 conference in New York City in 2018 about flexibility and complexity, and I mentioned there that all complex systems, due to the curse of dimensionality, they try to juggle too many variables at once, and they miss them all. They miss the targets in all of them, and eventually they collapse because there is no compromise possible. when you have too many variables, the only solutions that are feasible are the extremes. And this only the mathematical people know it. And they keep it a secret because it's scary. You don't hear it. It's so scary when you realize that in complex systems, the only possible solutions, social systems, are the extremes. Then you realize why there are extreme political parties, extreme fluctuations in the markets, everything is extreme. And as the complexity increases, AI, technology, the systems become more complex and the extremes intensify and create higher fluctuations and volatility until the systems excite a mode structural that breaks them. Now, the United States has a better system than Europe or, of course, the other autocratic countries like Russia and China are completely centralized. Although they have some decentralized puppets, but the decision has said that the United States has a republic. I don't want to turn this to political, but in the states, and I don't like politics. You know that. I try to stay away. But this is a better decentralized system, and United States will survive. I'm confident. The turmoil that is coming ahead, it will be pain. The standard of living will decrease, but United States will survive.
Yeah, for that reason, because it is superior not to have that top-down management of this huge geographic area with all these people to create one solution for everybody. It really creates a mess.
As long as it stays a republic, if the notion of republic is attacked, then we don't know what will happen. But that's why the wise men, they made it republic, because they knew.
You know what? I feel like this point about complexity goes back to something I said before. Complexity, it's just like what I was saying about, everybody talks about how active management underperforms, and yet here it still is. And complexity is like that too. It only makes it into the headlines when something like a pandemic or long-term capital or, some other event reminds the world that an economy is a large, complex system, and if you mess with it in various ways, you could have an accident, right? A normal accident. Again, but our memory is short, right? We get 2008, and then we forget, and we go and we just continue on and still keep trying to manage it from the top down. And I thought you tweeted something about the Federal Reserve, the complexity of what lies ahead, and the fact that the Federal Reserve doesn't really know what it's doing, right? They're just playing around and hoping the numbers turn out, not too terrible.
They have the ability to change the rates, but they are lagging in indicators. It's not possible, but they are trying. I like Jay Powell. I think he's an honest man. Honest, really. When he speaks, he's honest. But his job to balance, it's like in a circus. It's like in a circus without a net. Without a net below.
Yeah, the job is undoable, basically. But I agree. He is an honest man. He tells you exactly what he's thinking, and
people don't understand. He's not sleeping well.
All right. Well, with that, Michael, I think we're coming to the end of our time actually here. And I do have one final question that I ask all my guests, all of them. I ask them all the exact same question, no matter what the topic is. And I would just ask them if they could leave our listeners with a single thought, a single idea, whether it's about life or trading or economics or anything. What single thought is on your mind that you'd like to leave them with today?
Oh, that's a great question. I will say believe in the future.
Wow. Believe in the future. That's very optimistic.
Because the future drives the present. The present doesn't drive the future.
The future drives the present.
The future, yes, the future drives the present. It's where we are destined to go that drives our path. So believe in that. It also applies to investment decisions and everything. People must be careful about risk. Don't put their eggs in one basket. Don't go buy Tesla with all your money, because tomorrow, this guy may say something and the stock may lose 80% in one day.
That's excellent. Believe in the future. And your point about the future driving the present, I've never heard anyone put it that way. That alone is worth the price of admission, folks. That was great. Well, Michael, thanks for being here. It was really a pleasure to talk with you and just hear your opinions and thoughts about all these various topics.
Thank you for having me on. I appreciate your invitation, and I wish you the best.
Oh, thank you. Same to you, sir. Yes.
With your business and podcasts and investments, and to your listeners.
All right. Yes. And the same to you. And, maybe we'll have to have you back one day.
All right. I'm looking forward.
Thanks again.
Thank you. Bye-bye.
Many mainstream analysts are predicting that stocks will recover soon. But I say we'll instead witness a cash frenzy unlike we've experienced in 21 years before stocks recover. And I'm urging Americans not to buy a single stock until they see it. I predicted the Lehman Brothers crash in 2008, and I called the top of the NASDAQ in 2021. But this is the number one most important thing to pay attention to for 2023. And I'm not talking about another market crash or politics or inflation or any of these other things. As all this unfolds, the financial consequences of what I'm talking about could last for several decades if you don't understand what's happening. There will be winners and losers, and now is the time to decide which one you'll be. This is why I strongly encourage you to read about my warning totally free today. It's all spelled out in a free report we've put together. Get the facts yourself. Go to www.stockdeadzone.com to get your free copy of this report. You can learn how to get my 4 steps to prepare for what's coming. Again, that's www.stockdeadzone for a free copy of this new report. Okay, that was something I've been looking forward to for some time. Michael's a very sophisticated guy. He speaks a sophisticated language, but there's a lot to learn in there. And I'm also glad that he gave me his opinion about the euro and a few other things, and told us the story about his early trading days. Good stuff. He's at priceactionlab.com. He's got a lot of stuff there that's for free and subscribing. And if you're a serious trader, it'll make sense to you. Wow, I really enjoyed that. That's another interview, and that's another episode of the Stansberry Investor Hour. I hope you enjoyed it as much as we did. We do provide a transcript for every episode. Just go to www.investorhour.com, click on the episode you want, scroll all the way down, click on the word transcript, and enjoy. If you like this episode and know anybody else who might like it, tell them to check it out on their podcast app or at investorhour.com. And do me a favor, subscribe to the show on iTunes, Google Play, or wherever you listen to podcasts. And while you're there, help us grow with a rate and a review. Follow us on Facebook and Instagram. Our handle is @InvestorHour. On Twitter, our handle is @Investor_Hour. Have a guest you want us to interview? Drop us a note at feedback@investorhour.com or call the listener feedback line 800-381-2357. Tell us what's on your mind and hear your voice on the show. For my co-host, Corey McLaughlin, till next week, I'm Dan Ferris. Thanks for listening.
Thank you for listening to this episode of the Stansberry Investor Hour. To access today's notes and receive notice of upcoming episodes, go to investorhour.com and enter your email. Have a question for Dan? Send him an email. feedback@investorhour.com. This broadcast is for entertainment purposes only and should not be considered personalized investment advice. Trading stocks and all other financial instruments involves risk. You should not make any investment decision based solely on what you hear. Stansberry Investor Hour is produced by Stansberry Research and is copyrighted by the Stansberry Radio Network.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates. You should not treat any opinion expressed on this program as a specific inducement to make a particular investment or follow a particular strategy, but only as an expression of opinion. Neither Stansberry Research nor its parent company or affiliates warrant the completeness or accuracy of the information expressed on this program, and it should not be relied upon as such. Stansberry Research, its affiliates, and subsidiaries are not under any obligation to update or correct any information provided on the program. The statements and opinions expressed on this program are subject to change without notice. No part of the contributor's compensation from Stansberry Research is related to the specific opinions they express. Past performance is not indicative of future results. Stansberry Research does not guarantee any specific outcome or profit. You should be aware of the real risk of loss in following any strategy or investment discussed on this program. Strategies or investments discussed may fluctuate in price or value. Investors may get back less than invested. Investments or strategies mentioned on this program may not be suitable for you. This material does not take into account your particular investment objectives, financial situation, or needs, and is not intended as a recommendation that is appropriate for you. You must make an independent decision regarding investments or strategies mentioned on this program. Before acting on information on the program, you should consider whether it is suitable for your particular circumstances and strongly consider seeking advice from your own financial or investment advisor.